Topic focuses on risk measurement, risk management, and the systems used to monitor complex alternative investment portfolios. The topic emphasizes that risk management is the primary focus of the investment management process because protecting capital and controlling exposures are essential for long-term portfolio sustainability. Alternative investments introduce additional challenges related to leverage, illiquidity, derivatives, operational complexity, and limited transparency. Effective risk management therefore requires sophisticated systems capable of collecting, aggregating, analyzing, and reporting large volumes of financial and operational data. The program explains that successful investment oversight depends on integrating quantitative risk analysis with qualitative assessments, governance procedures, operational controls, and continuous monitoring across multiple investment strategies and time horizons. The topic first examines risk measurement and aggregation, which involve identifying and consolidating exposures across portfolios, managers, strategies, sectors, and asset classes. Risk aggregation helps investors understand total portfolio exposure rather than viewing individual investments in isolation. The program explains that risk systems must evaluate multiple dimensions of risk, including market risk, credit risk, liquidity risk, operational risk, counterparty risk, and leverage risk. Effective systems also monitor correlations, concentration exposures, volatility, skewness, kurtosis, and downside risk measures. Because alternative investments may contain nonlinear exposures and illiquid assets, traditional risk metrics alone may underestimate potential losses. Consequently, investors often combine quantitative models with stress testing, scenario analysis, and qualitative oversight to better capture tail risks and evolving market conditions. A major focus of the program involves categories of information collected at different reporting frequencies to support ongoing risk management. Daily data collection generally includes market prices, portfolio valuations, leverage ratios, margin balances, moving averages, and risk exposure changes. Weekly reporting often tracks gross and net exposures, futures positions, fixed income sensitivities, and leverage trends across managers and strategies. Monthly reports typically analyze portfolio allocations, sector exposures, turnover rates, and attribution results at multiple organizational levels. These reporting structures help investment professionals identify unusual trends, monitor changing risk conditions, and respond quickly to deteriorating exposures before they become significant threats. Timely and accurate data collection is therefore critical for effective oversight and informed investment decision-making. The topic also emphasizes the importance of quarterly and annual reviews in evaluating alternative investment managers and operational infrastructure. Quarterly reviews frequently involve manager calls, liquidity assessments, qualitative evaluations, and operational monitoring processes that may extend over several weeks. Investors assess changes in strategy implementation, personnel, valuation practices, risk controls, and market outlooks during these evaluations. Annual reviews often include on-site visits focused separately on investment due diligence and business operations. The program explains that operational due diligence is especially important in alternative investments because weak controls, governance failures, and inadequate infrastructure can significantly increase operational and fraud-related risks. Comprehensive review processes therefore complement quantitative risk analysis by incorporating qualitative assessments of management quality, organizational stability, and operational effectiveness. Cybersecurity issues represent another important topic within the topic because investment firms increasingly depend on interconnected digital systems, electronic trading infrastructure, and sensitive client information. Cybersecurity threats include data breaches, ransomware attacks, unauthorized trading activity, operational disruptions, and theft of confidential information. The program discusses regulatory expectations and best practices for cybersecurity oversight, including penetration testing, vulnerability scans, employee training, access controls, incident response planning, and ongoing risk assessments. Financial institutions must identify critical systems containing sensitive data and continuously monitor evolving cyber threats. The topic emphasizes that cybersecurity is now an essential component of operational risk management because technological failures or cyber attacks can create severe financial, legal, reputational, and regulatory consequences for investment organizations. The program concludes by examining broader risk management structures and organizational processes within investment institutions. Effective risk management requires clear governance frameworks, independent oversight functions, defined reporting responsibilities, and strong communication between portfolio managers, risk analysts, operations teams, and senior leadership. Risk management systems should integrate historical analysis, forward-looking scenario testing, and real-time monitoring capabilities to support proactive decision-making. The topic also highlights the importance of balancing quantitative sophistication with human judgment, because models cannot capture every potential market disruption or operational weakness. Ultimately, successful risk management depends on organizational discipline, strong internal controls, transparent reporting, and continuous reassessment of evolving risks. These systems help institutions protect capital, maintain operational resilience, and achieve long-term investment objectives under uncertain market conditions.